Welcome everyone, thank you for joining us. I'm Chris Rossi, your moderator for this event. Reply is extremely pleased to be a gold sponsor of the Economist Climate Risk event. Joining me for this chat is David Soutens, non-executive director of several financial service entities, former CEO of State Street Luxembourg, and of course senior advisor to Reply. Thank you, David, welcome.
Thanks, Chris. Great to be here.
Thank you, happy you could join us. Okay, David, we have an interesting transition risk case study to get to. A historically important customer of our banking firm requests financing of a new 10-year project, which can be classified as climate change mitigation according to the new EU taxonomy regulation. The customer asks for at least $1 billion in long-term financing, requesting funds via project finance from the lending arm of the bank, or via purchase of its corporate bonds via asset management. The customer itself is a publicly traded energy company based in Europe and relies on a global value chain and network of resources throughout the world. Mm-hmm. The customer has a brown reputation, unfortunately, and has received negative publicity in recent years from vocal investors and also environmentalists. Mm-hmm. The company wishes to transition towards a new renewable energy business, though it has very few renewable energy assets at the moment. The customer is recognized, however, as having good governance and social standards. Top management of the financial institution is given this information in separate committees. First, through a strategic risk committee for the lending arm, and secondly, through the asset management investment committee. Okay? The firm must decide whether or not they will do business with this client and moving forward. So David, the IPCC report from August 21 painted a pretty grim picture of things. Mm-hmm. We must reduce greenhouse gas emissions to mitigate the physical risks of climate change, inevitably augmenting the amount of transition risks in the financial system. So, first question would be, are financial service firms morally compelled to take on these additional transition risks to meet the moment and help support this transition?
Yeah, for me, the last part of the question is definitely a big yes. Because if there's no planet anymore, there are no financial firms anymore, and we're out of a job as well. And this is the moment really to take concrete action. So we should not just be, when discussing this topic and the business case you presented, we're just not thinking and limit our thinking just about the physical risks. There's also many non-physical risks as a result of this, of climate change and the transition risk. If you think about the disruption it's going to cause to the supply chains, the emerging poverty. Then secondly, I think when looking at the business case, we should realize that of the top 100 firms in the world, they produce 70% of the things we don't want to be around anymore going forward. And also the EBA transparency exercise in 2020 led that 35% of the bank lending books are consumed by the transition cases that you presented. So I just want to make clear to the audience that transition risk is not the exception. They are the most common in the portfolio. It's easy to discuss a dark green case or a very dark brown case, but the transition cases, like the one you presented, are the tougher cookies. So when discussing this case, I think we really need to watch the governance of both the banking, the lending side, and the investment side. We need to look at risk appetites and the data needs, etc. But also important elements like staffing and whether you're fully staffed as an institution for this.
Can you describe a bit more what it means, the governance for these financial firms?
Yeah. Basically referring back to the business case, governance is really, I would say, always the top of the pyramid. And immediately, at least for me as a practitioner, the differentiation becomes clear between what the asset management segment is doing or the investment firms are doing and where the banks are with respect to their governance around this topic. And what I've witnessed is that investment firms, asset managers, started much earlier this journey. And the journey didn't start by regulation, but started really coming from client demands, investor demand, etc., especially pension funds. And so as a result, it quickly infiltrated, I would say, the front office and the product area, the front office or the portfolio manager teams. Mm-hmm. So as a result, it's less driven by the risk area and so on, but much more driven by the investment committee headed up by the chief investment officer. And banks have approached the topic from a different angle. I would say banks were maybe slower to react. Yes, it's true, and I should give banks credit there, that clearly there was the involvement in microfinance, etc., which has been there for many years with a number of institutions. So I would say due to the acceleration in regulation and supervision, banks have now started to mobilize, often still led by the risk teams. Because a lot of focus on the regulation and on the resulting reporting. And the way they've started with it is often, I mean, there are different pictures there in the industry, but it's often a center of excellence in a sustainability team or a risk team, sometimes even combined with ambassadors already further elsewhere in the organization, where again the asset managers have kind of are away from the centers of excellence. It has now infiltrated all portfolio management teams, I would say, with the major asset managers. Now, you say, well, David, you paint here a very rosy picture for the asset management segment, and I would say that's not the case. Like, for example, asset managers, and there are reports around that, have been much slower on the reporting on their sustainability side. So yes, they perform maybe better on the fund side, but how they are doing as firms on sustainability and their reporting of their balance sheet, of their institution, balance sheet between brackets, of course, for an asset manager, they perform lower than what banks have done. I think banks have a longer history with producing sustainability reports, non-financial reports to their investor community already.
David, the reporting aspect was for sure a complex item that we talked about in our CRO survey through our competency center. We literally just looked at the numbers, but risk appetite, where do they start? Where does it end? Is it going to be a revisionary process for the next 10 years?
Okay. I think there again, if we look back at the business case, there's differentiation clearly between the asset managers and the banks. And probably it's more simple on the asset management side there, because at the end the risk appetite is defined within the fund itself, and that's what the investor buys into. It's not the risk appetite of the balance sheet of the asset manager. Here you're really talking about the risk appetite of the balance sheet, so we're looking really into that banking segment, I would say. And the CRO will really need to define that risk appetite aligned with a climate business strategy. And if there's no climate business strategy, basically he should push the other C-suite executives to define a climate business strategy, because otherwise, I think again, you risk to make it just a risk exercise, but it needs to be a business drive as well. Now, once you have defined the risk appetite, clearly then you're looking at your practices and how it really gets integrated into your processes, etc. Not only again in the risk practice, but also in the front office when interacting with the clients, when assessing the clients. Again, going back to the business case, how do you discuss in such a brown transition case, how do you not only discuss their current status with that client, but also what are their plans for the future? And is that amount that they're asking for related to their future plans, or are they going back in time or whatever? The other point I would say with the risk appetite at that level is that what we hear is when we start to interact with certain CEOs and CROs is that there is an emerging worry in the industry that because of this dialogue, let's say, that certain firms get excluded more and more, or prices and covenants are going up, which ultimately we need to watch, because it could create an unknown systemic risk that certain firms are excluded and then we're putting all the bets on the other firms. So a risk appetite that's just exclusion based is not good enough.
Yeah, that's a good point you make. Are we able on the asset management side or on a lending side to quantify whether there will be, what the amount of risk will be for this type of deal looking forward?
So I think what you will see is that the cost of capital ultimately will go up for these kind of deals. The covenants, which were probably relatively light in the past for big names and big tickets like that, will significantly go up. as a result of the climate change risk and the climate transition risk.
So, there's the ECB stress test that is basically launched this summer, which is going to go all the way to the end of next year, or the middle of next year, excuse me. Are we able to do some sort of forward-looking scenario analysis on this type of deal and say what it will be and what it won't be 10 years from now?
Comparing the asset management and the banking segment, the asset managers, of course, clearly stress financially their funds. Are they stressing them for climate change yet? I think very early days there again. They may start to stress them more for CO2 emissions and so on, but still there is some more stable data on that, but still very early days per issuer name or per line in the fund. For banks, for stress testing, I think you and I have been confronted enough with stress testing in the past for banks, but I think you realize that it's a different ballgame here.
Yeah.
Because the traditional stress testing that you and I have seen and we have applied and we've exercised is a 3 to 5 year horizon,
right,
and often financial operational risk stresses, but only 3 to 5 year scenarios.
And typically not that bottom-up type strategy that will need to be applied at the single deal level if you want to actually know what the deal will look like in 10 years' time.
Exactly. And here, to your point, to connect, it's a longer term horizon, much longer term. It's also probably you need to start to craft them specific to the sector. Agriculture, oil, transportation, they will behave differently under different stress tests. And then what you probably also need to take into account over these longer terms is policy stress test shocks. I mean, policy may change, the public opinion around these topics, so they may intervene on the results of your stress testing. And secondly, an unknown factor, but which is coming more and more to the surface again, is now the litigation risk, as we saw in the recent Shell case. That suddenly litigation risk starts to
creep in,
create certain big financial risks.
Well, stress testing itself implicitly requires data. Also, you talked about data in your introduction to the challenges and opportunities before.
Yeah, I think you're a far bigger expert there than I am. But I think there is a mixture being created on both sides of the fence. I would say asset managers and banks of market data, but we know many sources, and you need to choose them carefully and assess them carefully by your teams. But then there's also real internal data being created. At the end, if you look at the banks, they are the closest to these credit files. They can have a different dialogue there with the client than they historically had, where it was purely centered around financials, supply chain, etc.
I mean, I've seen very recently intense competition between info providers for publicly traded companies. From my vantage point, they're also working very, very hard, maybe day and night, to supply the data that's needed for sustainability disclosures on the wealth management, asset management side, but also on the risk side. So there are some approaches there. We've seen questionnaires, new ESG oriented questionnaires, risk assessment questionnaires, where the counterparty is solicited to provide certain information. But let's say the caveat there is that it's not necessarily legally binding. It's not coming from the Chamber of Commerce source normally. But then there's other opportunities to re-engineer your credit process, your lending process, where you acquire new data. And this is, I think, where there's a huge main challenge, because it's a really high cost also to re-engineer these credit processes, acquire new data, a lot more new data points, utilize that data, put it to good use, and then be able to come back into those other topics you described before, stress testing, risk assessment, and whatnot. There are obviously other cases, maybe due diligence and data rooms to recover historical data that was not registered in the systems. But if you haven't started on these things, obviously you're not going to feel the results until maybe a year down the road at least. So the data topic is from our Crow survey, but you can look anywhere you want in the industry. You can see that the data topic is probably the number one topic, the number one challenge among financial firms at the moment.
One of the better quotes I've heard, so it's not mine, is that climate change data within financial firms is where accounting financial data was 30 years ago. So I need to be aware, we need to be collectively aware that we're on a journey there. But I was surprised to hear some cases that you and I heard recently where the threshold was put relatively high.
Yeah.
Here in the business case, we put a big case with a serious material credit exposure.
Mm-hmm.
But I've heard about cases where the climate risk assessment is being made already for credit files above from 1 million euros.
Yeah. And that's probably a lot of counterparties to sift through.
Yeah, and so these are clearly probably non-listed companies and so on.
Yeah.
So there, I think the financial institutions are going to sit on probably a treasure trove going forward of data related to climate change and the exposure those firms have.
All this begs the question from a personnel perspective, whether it's a lender or an asset manager, are these entities equipped to take on all these challenges and find new opportunities?
That's a very good question, because I think really talent is going to be a challenge also in this job market, I would say, because it's really a new skill and a new skill set that needs to be injected in the institutions that we were talking about for all the reasons I mentioned, and for all the knowledge you need to have, because we talked about climate change, but it's also going to be about biodiversity, etc. And I would not say that with a traditional economics degree or legal degree, or accounting degree, which were often the standard job things to become a trainee at the bank, that's going to be ideal. You need these other skills now as well. And maybe there's an opportunity also to really work together between the asset management segment and the banking segment, and really of exchanges of talent, I would say, because I think there can be a cross-fertilization of talent among those groups in dealing with the talent needs that we will have, combined with external injections, I would say. Yeah,
why not? And that makes perfect sense, literally. I mean, I hope that is the case moving forward, obviously, because again, we said pressing issue, time is of the essence, there are a lot of hot topics to address, and it's not just a commercial or regulatory topic. No. We're talking about the well-being of our planet and of our financial system in general. So.
And we need every shoulder.
Yeah, we need every shoulder. Exactly. Okay, so that's excellent. But again, going back to the IPCC report, we have to act immediately. Yeah. So do we not take on this deal? And from which perspective do you think we should take on this deal? From an asset management perspective, or from a lending perspective?
To start with, I think, if you think about what Mr. Draghi said after the global financial crisis, he really wanted to change the streams between debt and equity in Europe, because it was realized that the GFC in Europe created so much damage because a lot of this was on the lending side of the banks rather than on the equity side like in the US. And one thing was to switch that 80-20% relationship. For me, what was interesting when Europe and the European Commission came out about the Green Plan, that they also stressed that element again, or that they stressed is the wrong term, but underlined that term again. Yeah. Let's use this again to change our markets foundationally and shift it more to the market side rather than to the lending side. And then when you look at this deal, I think where asset managers potentially have an edge at the moment is that they can go deeper from their fiduciary duty in the interaction with the C-suite of the client, and pushing the client more on where are you really, what are your plans.
So like an active asset management technique that's kind of been honed for in recent years in asset management.
But of course that you should take into account also going forward capital, credit benefits, tax benefits, and so on, which may push it more to the lending arm. So I'm not black and white on this deal, whether you should do it through the asset management or lending arm. Clearly different considerations, different synergies. I think though it's important on what you mentioned during the business case that probably they need to find a room to get financed.
So that's a wrap. Thanks, David. You were a headliner today. We learned a lot. We talked about a lot of stuff, and it was really exciting and really insightful. Thanks again.
Thanks for the opportunity.
Thanks, David. And I want to thank you all for participating today, for viewing our video. It was a pleasure to speak with you today, and I hope you enjoyed it. I want to thank especially Georgia Pavia, Freddie Gielen, and Reply executives for making this event possible. Likewise, I want to thank the Reply marketing team for putting on this production. And I want to thank especially our support network and our competence center and all our colleagues who work on climate risk. Thank you so much, and thank you to everybody.